Hey, YouTube. This is Gary from FIDA Fund. I just wanted to take today's time to go through some kind of investment loan, because a non-qualified mortgage investment loan, which is called a DSCR loan. DSCR stands for debt service coverage ratio. A lot of people use it as a vehicle to finance investment property without any kind of documentations with personal income. So the way it works is it uses the subject property's assets, right? The perceived rent divided by the expenses of the debt services of the subject, right? So in a sense, I wanted to show it to you. So it's called a debt service coverage ratio loan, right? It's a non-qualified mortgage, right? With no personal income needed. Basically based on the subject property income, right? So again, it uses the scheduled rent divided by the PITIA of the subject of the property, right? So what is PITIA? P is a principal, I is interest, T is taxes, base means property taxes, I means HO insurance, basically the homeowner insurance, and A is HOA, right, or association, if there is any. So let's say, for example, right, if we got a property that is bringing in $3,000 a month, right? So I mean, the way to get this is, the lender, once you go into contract, will order an appraisal, right, to estimate the actual value of the subject and also get a sense of how much the rent's going to be. So they will do two appraisal in one appraisal sitting, the value of the subject and also how much rent based on the market rent in the area. But I will show you another way is that, hey, so how would I know until before the appraisal? So there are ways that you can find out, like, sometimes a realtor is a good source of information. And then the other way is, like rentometer and things like that. And for short-term rental, if that's what you're planning to do, you can also use AirDNA, right? Some lenders actually accept that as perceived rent. So let's say if our subject, for example, is bringing in $3,000 a month, and then our PITIA is, $4,000 a month, right? That's PITIA, right? So this is the rent. Then your coverage ratio in this case would be 70%, 75%, right? To get better pricing, we would try to get 100% coverage. So, that means at least 4,000 month rent covering a $4,000 PITIA. So that would give you 100% coverage ratio, or sometimes called a 1 ratio. Of course, if the higher this number, the better rent is it. Usually, if you can even get to 1.25 coverage, you can get one of much better rates than if you got like a 1 coverage or 0.75 coverage. Then, hey, Gary, so what if my rent is only $2,000, right? And then my PITA is 4,000. You can still do a DSCR. Some lenders have something what we call a no ratio. So basically, they will, even if it's down to 0, I mean, which is very unlikely, they will still do the loan, but the rate would be much higher than if you have like 100 or 125% coverage. And other thing that you want to look out for DSCR is also not, 100% time. There's something called a prepayment penalty, that because it's, an investment loan, so the lender wants to, making more money than if a traditional, qualified mortgage. And it ranges from, there's a prepayment period, right? Usually it's from 0, means there's no prepayment, to 5 years. The longer the prepayment period is, so then the rate is going to be lower, right? And then the shorter it is, the rate is going to be higher, or you have to pay points for it. So it's kind of like a compensation for one versus the other. So what prepayment penalty does is, let's say, okay, if your prepayment penalty is 2 years, right? If you refinance or sell the property, right, or you pay it off, right, more than what you're supposed to, then they would charge you a prepayment penalty, and sometimes it's a percentage of the mortgage balance of the amount that you prepaid, right? Or they just charge you maybe like a flat 6 months of interest, right? Then that's your prepayment penalty. I mean, it kind of varies from one lender to another, so you have to check with your mortgage broker to see, what is the prepayment penalty for that particular lender. There are some states which prohibit the prepayment penalty. I know like Pennsylvania is one of them, up to a certain loan amount. And I think some area of Texas is also they don't allow prepayment penalty at all. So check with the lender and check with the program, and see what kind of prepayment penalty arrangement is there. Okay, so I think you got a pretty good understanding, just hopefully by now. But let's just find a subject, find out what's the rate today, right? And then we will calculate what's the coverage ratio, and you make the decision, based on the, that information, and see if that's something that you wanted to invest in. Okay, so let's use Redfin, because it's one of the easiest site to use, and I would choose Sacramento because I guess I mean you pick the area that you're interested in, right? And for doing this kind of analysis, you kind of think to yourself, is like, do I want to do a long-term rental, or do I want to do a short-term rental? What is your objective, right? And then you can calculate the return. So let's say, okay, if I go into Sacramento, there's universities and there's state capital is there. So it's a pretty hot or in desire rental market. So let's set up some criteria, right? So for sale, definitely price, let's say, I want to find something less than 400,000. Home type, I'll just stick with single family, townhomes and condos. I don't want to do any mobile home or exotic stuff. Let's say 3 bedrooms and above, because usually I can get better rent than if it's just 2 bedrooms. As you can see, I mean, hey, there's 62 homes available for me to choose from, and they all kind of looks pretty good. So let's see if there's any one that stands out. This first one's actually not bad. I mean, 350,000. It's got 4 bedrooms and 1,120 square feet. And you look inside to see how's the condition. The internet's kind of slow, but hey, you know what? It doesn't look bad, right? It's totally livable and rentable, right? So let's just use this as an example. So we know the address is 80 Redondo Avenue in Sacramento, 4-bed, 2-bath, right? And the listing price is 350,000. And Redfin thinks, yep, the price is very similar. So we just use 350,000 as our offer price. And if we choose, let's just use our DSCR template. Okay, let's just change the address. Okay. And it is a single family home. And we just use 3 years prepayment penalties, fixed mortgage, amortized, so not interest only. And we want to offer, let's say, 350,000 as listed, right? 20% down, so we don't have to worry about. Well, with non-QM, the good thing is there is never any mortgage insurance. It's not like traditional. So there won't be any mortgage insurance even if you put 10% down. So let's just do that. And then we need to find out 2 things right now. What's the rate, right? What kind of interest rate today? And also how much would the perceived rent is going to be, right? So let's go find our rates for now. Or before we do that, let's find out how much is the perceived rent, so we know what kind of coverage ratio that we have before we go into find out what the rate's going to be. So to find the perceived rent, you can go to, if you have a rentometer, I usually like to use that as an example because they tend to be a little bit conservative on the rent amount. If you have a rentometer account, be my guest, use your rentometer account. But if you don't, you can always go to my website, FIDAfund.com, and then in the middle of the site, I have a free rent analysis tool. It's basically rentometer, but it's, by going through my website, so you get it for free. Okay, so I'm going to pull out my own rentometer site, and then you need to put down the address. I forgot what the address is already. So 80, okay, 80 Redondo Avenue, Sacramento, okay? 4-bed, 2 baths, right? Okay, and then we want to look back 12 months rent, market rent history, and analyze. Okay, so it usually will give me a list of comparables, but just for simplicity, I mean, you can use the free, the full report and things like that. But just use, for our demonstration, let's just use the average, right? So the average in the area for 4-bed, 2-bath, single-family home in the area is about $2,700 a month, right? So now we know to go back to our Excel spreadsheet and put $2,700 a month. And now we can already see that, our debt service coverage ratio, congratulations, is over 100%, right? If the rate is indeed 8.5%. Okay, so next thing is we need to find out what the interest rate is going to be, right? Hopefully it's, no more than 8.5%, so that we can keep the DSCR at 1. To do that, usually, you may want to ask your mortgage broker or, your lender for that. Or AD Mortgage, I'm just using one of the, them as an example because they publish the pricing engine publicly, right? So let's say, okay, so to price it, what you do is you choose a non-QM. I think that's usually what they default to, and their citizenship status. You can even be a non-permanent resident if you to do a DSCR loan. Income type, in our case, is going to be DSCR, and just assume that is over 1, right? The coverage ratio. Occupancy turns red because you cannot do a DSCR loan on primary residence. It has to be investment property, and the purpose is purchase. It's not cash out or refinance, right? FICO score, just assume 760. LTV, it was, we put 20% down, so it's 80% loan to value. Our loan amount is $280,000, right? Okay, 30-day lock. We're not doing interest only, right? And then 30-year fixed, 1 unit, single family home, or it could be a condo if it's a condo. So let's say single family home, 1 unit, the state is California. And don't worry about broker's comp or lender pays comp, but basically for prepayment penalty, we're choosing 3 years. Okay, so we got a rate, right? Non-QM, DSCR, 30-year fixed. Okay, I don't really like 8.99 because, as you can see earlier, like we need to keep it under 8.5 to get at least 1+ coverage ratio. So if I lower the rate to, let's say, 8.5 exactly, then we have to pay at 1 discount point for this rate. Okay, so good, right? I mean, if you want to be a little bit more aggressive, you can go down to 7.99 and just pay 2.25 point. I mean, 2.125 of a point. But I'm cheap, so if it give me 1 coverage, then I think I'm okay with 8.49. So go back to our Excel spreadsheet, 8.49% rate. So I don't need to change anything, and great. So DSCR is over 1, so that's great. And then as far as closing costs, right? So the down payment would be the same as up here. Usually with purchase is about 1% of the purchase price. Appraisal, I would say, maybe $750. underwriting, maybe like 1,500. Lender points 1, right? Remember we saw earlier. So your total amount to close would be about 80,000, somewhere around there. And from here, I mean, you can then ask yourself, right? Hey, is this a good investment, right? If you're doing long-term rental, right? I think if it covers what you need to do, either buying it for long-term hold, it's probably some appreciation in the long term, or if you plan to do short-term rental, right? I mean, 9 out of 10 times you probably get better than 2,700 a month in rent. And like I said, there's lenders out there which will allow air DNA reports for perceived revenue, so you can use that as the rent performer, schedule rent, right? So let's say if it is 4,000 a month from air DNA, more power to you, right? So let's say if our coverage ratio is more than 1.25, then you may get actually like maybe the rate would drop to 8.125 or something, right? Then your positive cash flow would be better. So hopefully you guys understand DSCR loans. FIDA Fund can do DSCR loans in all 50 states, and our fees there's very, very attractive. And if you have any questions about DSCR loans or any lending questions in general, please feel free to give us a call, and would love to help you out in your investment journey. Thank you so much, and take care.